Right, you've got some big financial decisions coming up, and you're smart to want to get a deeper understanding of volatility. I mean, it's a term that gets thrown around a lot.
Yeah.
But what does it actually mean for your money?
It's a great question, and it's one that's often oversimplified. Volatility, at its heart, is really just a measure of how much an asset's price, like a stock, fluctuates over time. The more dramatic those price swings are, the higher the volatility.
So reading through your research, one of the things that jumps out from this Investopedia article is the link between volatility and uncertainty.
Mm.
The higher the volatility, the less predictable the price swings are,
Mm.
and therefore the higher the risk. It's like trying to time a wave as a surfer.
Right.
You might have a general idea, but that ocean's unpredictable. You never truly know how that wave is going to break.
That's a fantastic analogy. And it's why understanding volatility is so crucial for making informed investment decisions. Now, something else that's important to note is that not all volatility is created equal. You see, we have historical volatility, which, as the name suggests, looks at past price movements to understand how wildly a stock has swung in the past.
And then there's implied volatility, which feels a bit more like trying to forecast the weather. It's based on what options traders are betting on for the future price movements of a stock, right?
Exactly. Implied volatility gives us a fascinating glimpse into market sentiment, the overall mood and expectations of investors. High implied volatility suggests traders are anticipating big price swings, though it doesn't tell us which direction. It's a measure of uncertainty rather than direction.
So how do we actually measure volatility? The article mentions standard deviation.
It's a statistical tool, and I know that can sound a little intimidating, but it's actually pretty straightforward. Imagine charting out the price of a stock over a year. Standard deviation tells us how much those daily prices deviated from the average price over that period.
So a high standard deviation means the stock's price has been all over the map, volatile. A low standard deviation means it's been a much smoother ride.
Precisely. Now, while standard deviation quantifies historical volatility, the VIX, or the Volatility Index, provides insight into market sentiment for the future.
Ah, the VIX. The article called it a fear gauge for the entire stock market. That's pretty powerful imagery.
It is. Think of it this way. When investors are feeling anxious and uncertain, the VIX shoots up. When everyone's feeling confident and calm, the VIX stays low. It's that simple.
So we've got these different ways to measure volatility. But what does it all actually mean for someone like you who's trying to make smart investment decisions?
That's the million-dollar question, isn't it? And the first piece of advice might seem counterintuitive. Don't panic. Remember, volatility is a natural part of the market. It's not inherently good or bad.
Right. It's just a fact of life, like the changing seasons.
Exactly. And just like you wouldn't abandon your long-term plans because of a particularly harsh winter, you shouldn't make rash investment decisions based on short-term market fluctuations.
Easier said than done, I imagine, especially when you see your portfolio value dropping. But you're saying that understanding volatility can actually help us be more strategic.
Absolutely. Let's go back to the surfing analogy. Experienced surfers don't just paddle out blindly. They study the ocean. They wait for the right waves. And they know how to ride those waves for maximum impact. Volatility, in a way, is like those waves.
So are you saying that instead of fearing volatility, we can actually learn to ride it to our advantage?
Precisely. Remember how high volatility often leads to lower stock prices? That's where savvy investors can find opportunities. While others are panicking and selling, they're strategically buying those undervalued assets.
That's what people call buying the dip, right? But that takes a lot of courage.
Yeah.
And I imagine a solid understanding of what you're buying.
You're absolutely right. It's not just about blindly buying when prices drop. It requires research, discipline, and a well-defined investment strategy. And this leads us to another important strategy: hedging your bets.
Okay, so you're basically talking about creating some sort of safety net for your investments.
Precisely. Hedging involves using various strategies to protect yourself from significant losses. One common approach is buying put options, which give you the right but not the obligation to sell a stock at a predetermined price, even if the market plummets.
So if the stock price takes a nosedive, your put option acts like insurance, limiting your potential losses. It sounds like a smart way to manage risk, especially in a volatile market. You know, one thing the article didn't really get into was how volatility might be affected by things like high-frequency trading and algorithmic trading. Those weren't really around in the same way when the article was written. What are your thoughts on that?
That's an incredibly astute observation. And it's definitely something every investor should be thinking about. The financial markets have become far more complex with these sophisticated computer programs making lightning-fast trades.
Yeah, it's almost dizzying to think about the speed at which these algorithms operate. Do you think that increases volatility?
It certainly can, especially in the short term. Imagine a flock of birds suddenly taking flight. It creates a flurry of activity that can be difficult to predict. High-frequency trading can have a similar effect, amplifying those short-term price swings.
That's a powerful image. So how can investors even begin to navigate this new landscape where volatility is potentially being amplified by technology?
It really underscores the importance of taking a long-term perspective and focusing on fundamentals. Remember, short-term volatility is often driven by noise and speculation. By tuning out that noise and sticking to a well-defined strategy, investors can weather those short-term storms.
So to bring it all back to our listeners today, what are the key takeaways you hope they walk away with from this deep dive into volatility?
I think the most important thing is to remember that volatility isn't inherently good or bad. It's simply a characteristic of the market, like the wind or the waves. By understanding how volatility works, how to measure it, and how to manage its risks, investors can approach the markets with more confidence and clarity.
Beautifully said. It's not about trying to eliminate volatility altogether, which is impossible, but rather about learning to navigate it effectively, and perhaps even learning to ride those waves of opportunity when they arise.
Exactly, and never stop learning. The financial markets are constantly evolving, and what worked yesterday might not work tomorrow. Staying informed and adapting your strategies is crucial for long-term success.
Well, you've given us a lot to think about today, especially when it comes to navigating this increasingly complex world of finance. And you've given our listener, who I know has some big financial decisions coming up, a lot to consider as they chart their own financial journey. Thanks for joining us for this deep dive.
My pleasure.